Good afternoon, Scott Redler, T3 Live. Welcome to today's recap. So it is Monday, and it's a little bit of a different Monday because it's the last day of June. It's also the last day of the second quarter. So what does that say? It says a lot. It says a lot to everyone who's been maneuvering the market the first quarter, the second quarter. But it also depends on who you are and where you're at. You know, you have hedge fund guys out there that are trying to, create alpha. You have brokers out there that are trying to outdo the next one, and then you have traders who are active, which is pretty much our sweet spot, where we try and trade for P&L and trade monthly and try and have a living here in the market and do it day in and day out with our routine. And I will say that at mid-year, a lot of traders get depressed, because right now you see the S&P's up 6%. Some stocks have had big moves, and this is when people kind of get a little reflective on how they performed. Then they start either blaming QE or blaming the volume or blaming anything they can. But really, the only way you're ever going to have a good second half is if you, take accountability and see what you did right or what you did wrong. And there was definitely some things that happened out of the blue that you had to have some quick feet pretty much to start the year. The consensus was pretty much wrong in a lot of different areas, but you had some time to make adjustments, switch some gears and reevaluate and start to go with the flow versus fight the flow to try and be right in whether you're trying to make calls on Twitter or whether you're trying to provide for your family, whatever it is. There's been a lot to do and a lot of things that have taken place. We have a shortened week in front of us tomorrow. People are like, what do you think going into tomorrow? I'm like, you know what, we're still holding higher, and if it stays here, and portfolio managers who get new monthly money or new quarterly money, if they underperform, then they get yelled out for not being involved. It could cause a squeeze. Or if this was the window dressing that people thought because last week was choppy and then things held in because managers wanted to look good or get paid, then we'll know levels to look at also. But either way, there's been a lot of the same, a lot of things to do, and a lot of setups that keep triggering across the board. And for me, I try and be long when we're above the 8 and 21-day moving average. And then if we break and close below it, I try and be tactical. And then if we stay below and the price action tells me, then I try and be short. For the majority of this year, we've been above the 8 and 21-day. For the majority of the last 3 to 4 years, we've been above the 8 and the 21-day. And using that concept has been much better than reading the headlines, following the perma-bears on Twitter, or just hearing footsteps of the times of the past when there has been more volatile periods. And I think keeping the TV turned a little bit lower is very helpful. So real quickly, let's just go to the S&P. And some people are asking me to look at it a little bit closer just to show the first 2 quarters. So let's go to the chart and check out where we stand now and some trends that are still intact based on whether you're trading macro, intermediate, or even accelerated. So let's go to that chart. There you go, Andrew. We're at that chart. So anyway, here is the longer term trend, right? Here's, I do a lot of different presentations, and I've talked about the red dog reversal, and I've talked about this one here, and I've talked about the blaring one, the crazy one that took place back in 2011, all the way back there. But I'm not even going to get back there. I want to talk about, where we are here, okay? And basically, there's been, last year, there's a lot of different, little adjustment points. We talked about this outside day there. Remember this head and shoulders top there. This false breakout here. This was the majority of last year. Then you came in this year. And this year, if you remember, was kind of tough, right? Kind of tough. I know for me, I got blasted off the bat because it looked as if we were going to break out to start the year. Remember this right here? Looked as if it was going to get ready and go. Okay, it was like right here and looking like we're going to break above. The year before, we started out with new money coming in the first month of the year, and you had a nice trend to the upside, and that took place. I remember that day was probably the most painful day of the first part of the year for me because I was in 7 to 12 longs, above the 8-day, above the 21-day, feeling good, and pow. That probably got me closer to flat. But, rightly so, considering look what happened after that. So if you got stubborn and didn't switch gears here when we broke the 8 and broke the 21-day, you got really hurt right there. And I think right around here is when everyone in the world started calling for a market crash. We did go further, okay, but look how quick this transpired. All right, remember this? This was, your quick move down. If you missed that move down, you had a bear flag, okay, which nice technical pattern, right? You get stopped out here, you get a little tactical, figure out what's going on in here, not much of a rally, didn't take back, you know, the third of it, and then boom, broke below this 1772 and at least gave you a little bit more downside. And then what took place? A red dog reversal on the trend line, okay? So I know that everyone was calling for the first 10% correction, and maybe it could have happened, but this could have got you a little bit, you know, a little bit more neutral versus just neutral to crazy bearish. And then boom. So if you didn't cover here, okay, which if you were long and you caught that, great. Right here, you should have said if the bears have any control, they don't let the bulls reclaim at least this spot. And then what took place? Boom. So this 2 bars negated that. So right there, that said, okay, that was an overthrow. That was, you know, this move is no longer in control. Let's see what's next. And then not only did you get a small inside day, you were right back to where we broke down from. So this was boom, boom. And with that being said, there was lots of money to be lost and made in that time period. And that's what threw a lot of people off early on. And then, you know, in the next you know, month or so, that's when you had the internet stocks break down, you had the Russell breakdown, you had technology get weak, you know, the whole 9 yards. So let's start fast forwarding a little bit more to the chart here, and you know, let's just go back where you had the range. You know, after this overthrow to the downside, remember we had all these other overthrows. You had this overthrow right here, which was a false breakout. Boom, you had the red dog reversal, then came back in. You probably had to get out of your stocks because every time you have a false breakout and you're playing for momentum, typically warning sign, okay, and then from there you had to move lower. And then I remember here they took back probably more than the bears would have wanted, and everyone got squeezed out probably trying to short this bounce, and then boom, and then what happened again? Same similar pattern that you saw right here, where you had a little 3-day pivot. This one didn't make a new low, came back up, and then from there, finally a clean breakout. So now let's get back to where we are now. So you talk about last Tuesday, okay, you had that day to take notice. A day to take notice got me out of a lot of my longs, but this day to take notice got engulfed the next day. So right there I went from short in the brain to, you know, neutral to positive, looking for opportunities, considering look where the 21 day is. We're right on the 8 day, still looking just fine. And now, to make a long story short, heading into the next quarter, this is what you probably should look at. This is where we kind of broke out from. So you want to draw a trend line with the 21 day. As long as we stay above this 1944 to 1947, I would not be super bearish. And if we happen to hold in here and hold higher, at some point if we take this out, a lot of people are talking about 1975 to 1980 or higher. So this is what I will be looking at within the next week, you know, or even through earnings season, depends on what's going on. Real quick down memory lane too, the Qs. I know that everyone in the world, including me as a technician, talked about the potential head and shoulders top, okay, that took place or was forming, okay, right into here, and from here down, it held the first time, and look where it came from. So it was oversold. So you weren't sure if this was just a reflex move up or, you know, will it act better? And then you had a quick move into the trend line where it failed. Okay, so get a little short versus that. Why not? And then as thinking forward, I'd be like, okay, do we get a higher low or do we fall apart? And next time we come from a lower area, do we break through, create a higher low, and then touch there again? Next time, higher low, and then this time busted through. You had a little retest, and look what technology has done ever since. Riding the 8 day, clean breakout above the prior high. You know, if you were bearish here, you know, and lost money trying to be short in there, you had a lot of time to switch right here for what has been a great move. And right now we're above highs, and I like when technology is leading because there's a lot of faster moving stocks that, to me, you know, trade a lot cleaner, and I just do better in that scenario. Then you go to the Russell too, real quick. You know, this was when, you know, looked as if the world was going to end below the 200 day, but it didn't. Then it held higher. You broke this downtrend, held higher again, and even last week when everyone in the world was talking about, oh, look at it, it's a lower high, get short everything. You know what? It still held the 21 day, still reversed back up. You know, you're right back at this pivot. If you're short this and you're rolling it up, be careful, because if it takes out this 120, you're in a heap of trouble. Okay, and I know it's not outperforming for the year, but if you got out when it broke the 21 day here, okay, you had opportunities there when it broke the descending trend line or retest and held, or when it broke above this flag or it broke above here, to make a lot of money in some of these smaller caps. All right, so that's, inflection points. Inflection points happen every few weeks, every few months, once a quarter, and money rotates, and that's our job as intermediate trend traders to find, to create alpha, to create P&L, to get paid. As far as everyone has a macro plan every month, if you put in S&P funds, if you did it the day before the 1987 crash, you did okay if you stayed the course. If you invested your first dollar in the market right before Lehman went bankrupt, okay, and the S&P plummeted, and you kept every month doing it and didn't get scared out by the fear mongers or the guys that saying the world was going to end, you did all right. You had a great average cost, and you're still doing good. So, you got to know your time frame, and you have to know your plan. And I do think a macro approach, depending on your age, could work out over time. And historically, it pretty much works out to 7-8%. Even in that decade of the 2000, when you had to really navigate those ascending channels, descending channels, all that was doing was consolidating the 80s and the 90s that had a big move, and I've gone over that many times. So tomorrow, let's go back to some charts. Last week we talked about Apple, and gave us a really nice move, right, out of that descending channel there. We talked about how it could be a good opportunity here, and it wound up being a really nice trade. I did get long Apple here and took it home, was long all day Friday, came in today long, sold it, and now I'm going to wait. My rule, feeler, add, and then take some trades, and I was happy to hold it all the way till today. And now we'll see what's next. I do think at some point this gets taken out. I will wait for a bit more of a better setup. Okay, on this little area, I said iPhone to head. We should see 100 plus, and it's been a nice move and something nice to stay with, but we could trade it actively according to patterns if you do. If you sold it here, and then in a week from now you go away and you're away for July and August and it makes new highs, you're not going to be happy. If you were able to buy it back below 92, you won't care. So you have to know if you're a swing trader, if you're going to buy it back. So, like if you sold it here, you're like, oh great, I sold it here, saved myself 2 points, but if you didn't get back in it, you missed that. So you have to know what your time frame is there. Anyway, that looked better. Google still hanging around. I'll look at this the next day or so to see if it could continue higher. Nice little bull flag. Needs to really hold above 579 for it to continue above this 589. Netflix has been real quiet. A little topping tail here today out of play. I don't think you have to put too much emphasis here, but at some point there will be a decision point. Tesla, I came in long. I don't have it overnight. I don't think, if you look at juicy trades, this was a juicy trade right here, and then you had another juicy trade right there, and today it just felt a little lethargic. So, I did have it overnight. I added a little bit when it cleared this, and then when it came back below, I said, you know what, I'm going to be a little bit more tight, and I got out of it, so I don't have it overnight. But I'll probably re-enter it, and if you were in it for an intermediate basis, I wouldn't get concerned unless it breaks below this 234 to 232 zone. So, I would just continue to navigate it that way. Some of these other little ones, that got really beat up way back in, got something a little bit better. Anyway, that one of them I put on today was Faye. Some people ask me why. You know what? I didn't get caught in this mess, and here was when it started acting better. Like you have a downtrend here that it broke. It was really, really tight. Closed pretty well today, and looks as if it could trend up a little bit. The other stocks in that group that have been beat up have acted a little bit better. Data, SPLK, not blockbuster moves, but they're all trying to make their way back to the 200-day after getting beat up. And if someone like, oh, how did you see what went on in stocks like this? I said, no, technically I didn't trade this, but look at this huge outside day that closed below this range. That was your sell signal. And then even better, or a day to take notice, it never took back any of it. So that just showed you how weak it was. So if you didn't get out there, you had to be on alert and get out there. So anyway, trends change in these fast-moving stocks. And right now, this is, nothing spectacular, but it's been trending higher if you've tried to be involved in it. Same way we pointed at SSYS, not a blockbuster, but this too, if you were out of the way with the 3D printing stocks, here's when this little trend line broke, and then it got above resistance, and then created a nice little bull flag, and now it's been stutter stepping higher. So, there are entries that you could do from lower levels, and if you didn't get caught in the mess, it's kind of like Sperling's play of the week. I think it might have been last week. where, from down here to 59-ish, really nice percentage trade. But you got to take them. It's now extended from the moving averages and see what's next. The metals today, GLD closed on the highs. I'll say one thing right now. Here you have, your slice through resistance, consolidation, close on highs. Come back to me, Andrew. If the metals don't open up and I'll follow through tomorrow, I don't know why people trade them. They're so random and erratic, and if for some reason it takes back what it had today, these things are just headaches and traps and hard to deal with. I know people were so bearish on gold to start the year, and then finally when they got bullish, it pulled in, and then finally when they got bearish again, it went up. Now you had a bull flag continuation pattern. I know if this was in tech land, day one up, maybe people would be in huge size. But when you're talking about gold and everything happens overnight and it's a little erratic, hopefully maybe you're in some, it's the good book says, and you get paid for some follow through. So if you look here again at the GLDs, the right trade is to be long here overnight. The GDX also, which has been leading the way, nice little move up, consolidated that trade. Silver, was a little ahead of itself, but regrouped pretty nicely right here, held the moving average, and now if this were to clear this spot tomorrow, maybe that continues. Facebook, a little weaker today, but still in perspective. If you look at it here, it broke out. This is when it held big support, and still flagging, didn't participate today. There was a lot of talk about their privacy, whatever, the news feed manipulation, but anyway, held in there. I would still use this 66.46. Today, LinkedIn played a little bit of catch up, and it'd be nice if this gets to the 200-day. You had a clean day, closed pretty strong, not the best volume, but okay. So hopefully this could continue and you get a day two out. There hasn't been 2 days in a row in LinkedIn in a while. It'd be nice if that happens. I know some of us were looking at it here, and now it held sideways, went out of play to show relative strength, so hopefully you get something tomorrow. So with all that said, there's been a lot to do the first 2 quarters. There's been a lot of opinions out there, from the media to the Twitter sphere to myself to whomever. And opinions are only as good as, I don't even know if they're good for anything, but only as good if the market confirms them. We've had the adjustment points on lots of different time frames. There's been a lot of leg sweeps to the consensus that could have hurt, but could have hurt a heck of a lot more if you made it, you didn't make adjustments and got stubborn. So here we are to start the new quarter. I'm not saying do anything so crazy and new, but this week I would just take it a little bit easier. Could be thin. You have jobs Friday on Thursday. You have a long weekend with July 4th. Just make sure that if you're behind the 8 ball and you're not having a good year, don't just start getting all rambunctious and put yourself out of the business. Look at what you did wrong. Make small changes. Get green. You get green a few days in a row. Then all of a sudden you feel better. You add to your size, and then all of a sudden you start taking more positions either which way, and then your P&L gets back to where it once was. But if you're going to do everything the way you were doing it prior, and the bad habits and following people who are doomsday guys that the market doesn't confirm their doomsday thesis, you're not gonna get anywhere. So make some changes for the best. Small steps lead to firmer ground. I've heard that somewhere before, and hopefully if you're in our community, I think there was a lot of high-fiving going on today because we've been trying to be constructive on the market, glass half full. Congratulations. A lot of people had their best day today, whether it was GWPH, whether it was Apple from Thursday, whether it's been Tesla. Good job. You're making progress. You're watching the videos. You're using off the charts. Hopefully you're a member of Redler All Access. You're using your resources. There are a lot of resources out there that you can learn how to use and then combine it with your strategy and then get better or more conviction to put on that trade the right way. It's quarters behind us. Let's move forward. See you tomorrow morning.